Is everything really coming up roses? Shouldn't we be more bullish in this environment? We asked our traders to come up with the charts they think tells the real story of this market.
Well, first of all, Courtney, Bonawyn, Tim have been bullish. So I have not, and I want to be clear. So days like today, it definitely leaves me scratching my head. But you look at the market, everything clearly is coming up roses. But then you hear the commentary out of the Fed yesterday. Again, we said it last night. If you played the game, you hear these comments. What's the market going to do? I thought the market would crater. It did not. I think the China stimulus, whatever you want to call it, clearly is helping. But that's not the only reason why. But the thing that has me scratching my head, if we're going to go right to it, is this 2s10s, which inverted to the tune of about 111 basis points, traded back down about 42. Now it's reinverting. That's not bullish. I mean, what does it speak to? In my opinion, it speaks to the front end of the curve, where inflation is still a problem, as manifesting in the 2-year, and the back end, which seemingly is going lower, for now at least, means the economy is slowing down. And that is not a healthy long-term recipe for equities, in my opinion.
I would agree with that, except that this has been inverted for quite some time now, and it's the recession that never comes. And so at this point, what do you do? I mean, how much do you take stock in that at this point, since it hasn't been a great indicator so far?
It hasn't. I think there are actually still a lot of positives when you look at the economy, and that's really what people are starting to price in. We're still seeing unemployment really low. We just saw spending data come out, and consumers are still spending like they're really not worried what's going to happen with their jobs, and they're really not worried about wages. And that's really what's keeping the economy going. That's like 2/3 of GDP right now. And so as long as you're continuing to see that, the recession does continue to get pushed out. And I think when you're looking at the markets here, they did hear the Fed yesterday, and what they heard was they're pausing right now. And they were pretty definitive. They said nothing is on the table yet. So they're probably going to hike, and that's what's getting priced in right now. But the Fed, a year and a half ago, was saying we're not even thinking about raising interest rates. And now they're saying there's no chance we're going to cut. I think at some point people are saying, well, if the data keeps showing inflation's coming down, aren't you going to follow that? And I think that's why you're seeing the S&P continue to improve despite what the Fed did yesterday.
So your chart is the S&P?
The S&P, which has continued to improve despite what, some are seeing as a hawkish Fed yesterday. And I think that's just showing the markets are kind of ignoring them at this point, and they're looking past that.
I mean, you have to wonder if the Fed has reached peak, not credibility. What's the opposite? I mean, loss of credibility. The markets are doing this in spite of 12 of 18 members saying 2 hikes, 3 members saying 6%. And we have not talked about anything with a 6 handle for a while, and yet here it is.
Yeah, that's true. I mean, I think on some level, though, you can say that people believe that the Fed is doing what they're going to say, which is they may raise 2 more. They're data dependent, and that could mean that they're done. If they're done, if we've peaked on rates, we've peaked on dollar, we've peaked on inflation, there's a lot of reasons why equities have done what they've done. By the way, we've been talking about music the last couple of nights on this show. I'm surprised we didn't play Everything is Awesome by Sarah and Tegan, because that's usually the song we play when the market's going crazy. So our team has some chance to cue that one up for the B block. My chart is ultimately the forward PE on the NASDAQ. It could be the forward PE on the S&P as well, but on the NASDAQ, it's a little bit over 30 times based upon today's close. And if you look at where we were going into pre-COVID, we were probably around a 20 times forward. Take those companies. Take the aforementioned Microsoft, which went to all-time highs today, up 57% since January 6th. Why? I mean, I kind of know why, but I don't know why. And I look at that forward PE, and we say this all the time, and Guy does say this, Dan does say this, and they're right. It's multiple expansion. It's not earnings expansion. So the thing that's the most concerning chart to me is this market at some point is just absurdly expensive. And I'm talking about the biggest companies of the world and some of the companies that don't make a lot of money. Of course, they're expensive. They've gotten more expensive on some level. So that's the chart, the forward PE. But the forward PE on the S&P is at about 19.4 times. And that, again, if you look at where we were in the 5 years pre-COVID, we were at 16.5. So it's about multiples.
But do you think that because this PE is so high at this point for the biggest mega cap stocks, that means that the whole market will come down, or that this market is set next to broaden in terms of the participants?
I think the market is broadening. And I think since SVB, that knocked what was broadening that was going on. And if you look at the 11 sectors in the S&P, they've all joined in over the last 6 days. They've all been higher effectively during that time. So it implies broadening. But at some point, it does come back to valuation.
Yeah. In terms of this market picture, you're worried about inflation and the consumer.
Yep. And crude. So, like you said, first of all, let me turn to Guy and say thank you. I love free stars because I most certainly have not been bullish. I've been bullish certain pockets of the market and that mega cap tech. So I'm going to take my medicine along with you now that we've got the tussin out of the way. Yes, I have been concentrated on the consumer, and crude to me is what tells that story. If you look back a year ago, we were at 120. Now we're just above 70. And I think when we know that that's not in like the core inflation numbers, but it definitely speaks to the health of the consumer and their ability to spend. That's ultimately why we're all roses, or perceived to be all roses, because the consumer has been extremely resilient despite all the turmoil that's going on. And so when I look at a chart that kind of gives me some insight into where the market is, I think when it comes to input costs or the consumer, things of that nature, the crude tells you a picture. And if that were to turn and pivot, I think we'd be singing a different tune.